powered by Riverside FM.
You cannot beat the market long term. This saying is used to highlight that it's extremely difficult for investors, whether they are amateur or professional, to consistently achieve financial returns that exceed the average of market returns. It is a note of caution that the stock market is not a get-rich-quick scheme, and seldom will high returns persist for an individual. Accordingly, those that feel that they might be able to outwit the market are actually very unlikely to do so. The phrase is also the wisdom that underlies the recent growth in passive funds. Passive funds are funds that are designed to replicate overall market performance. They are typically designed to mirror the performance of a particular index. For instance, in the UK, the FTSE 100 is an index of the share prices of 100 large firms. It includes companies such as AstraZeneca, BP, Standard Chartered, Barclays, HSBC, and Shell. Thus, by purchasing shares in every company within the FTSE 100 and simply holding them, a passive fund can replicate the performance of the FTSE. If the FTSE goes up, so does the value of that fund. In the UK, this kind of passive investing has increased significantly over the last 30 years, from about 1% of all investment in the early 1990s to almost 50% today. The trend reflects a number of things, including an increasing number of private individual investors who wish to keep things simple and simply accept a long-term market return. Indeed, if you believe in that initial statement that you cannot beat the market long-term, it of course makes sense. You should seek to replicate the market return. This is what passive investing tries to do. But it also has other advantages over active investing. The initial statement's logic suggests that active funds cannot outperform other funds. Whilst they might buy and sell, sometimes outperforming, sometimes underperforming, on average, they will just achieve the same return as a passive fund. However, the key benefit from the passive fund is that it is cheaper. You are not paying for the services of active fund managers to be analyzing and making trades. Not paying this cost can be a significant saving. Accordingly, passive funds have attracted more and more customers. But let's explore them a bit further. In fact, let's explore the initial assumption that you can't beat the market long term. Where does it come from? Because clearly not everybody believes this to be true, as some investors do continue to make active trades. The simple interpretation of the phrase is that markets are efficient, and therefore current share prices of companies do in fact reflect the value of those companies, at least the best possible estimate of the value of those companies given current information. Clearly, over time, such values can change. And when the values do change, it's the result of new information, or news. This is information that was not priced into the previous share price. And since it's news, by definition, it must therefore be random. Taking this a step further and through to its logical conclusion, it implies that all current prices are accurate estimates of true values, that accordingly the market is efficient, and that as random news comes in, their prices will change. If you have a sufficiently broad portfolio, you absorb these price changes and shocks, and you simply earn the overall market return. Within that, for those that do not have a broad portfolio, there are inevitably some winners and losers. Some people will have picked stocks which outperform, whilst others have picked stocks which underperform. And so indeed, there will be some people who beat the market, and there will be others where the market beats them. But this is beating the market only in the sense that they get a higher return than the average in the short term. There is no basis by which they continue to earn higher returns in the long run. Their initial short-term return came by pure luck of being on the right side of the news. This all suggests that for the casual investor, putting money into passive funds is a sensible, straightforward form of investment. Indeed, many financial advisors, of which I am not one, and I probably need to stress that under some financial regulation, but many financial advisors would suggest investing in passive funds. Next, though, let's move away from looking at the individual investor and think about the overall market outcome. And let's take this to the extreme. What would happen if all investors invested only in passive funds? This simply wouldn't work for a number of reasons. Firstly, it would involve the end of analysts assessing the ongoing value of companies. If everyone moved to passive investing, a mechanism would be lost whereby prices would adjust to reflect companies' true value and their ongoing performance. Accordingly, some inefficient old companies would continue to receive investment at a value which they did not justify. This is poor for the companies involved and for the investors themselves. Likewise, some new companies would lose out on the opportunity to earn investment, when in fact it would have been beneficial for them to do so. Indeed, at some point, if a market shock does arise, there will be increased market volatility because of the underlying divergence in prices from true value. Related to this, if there is only passive investing, there will be a reduced incentive for good governance of the underlying companies themselves. Company management is accountable to shareholders, and if those shareholders are only passively engaging with the companies, they have a reduced incentive to undertake good operational control and strong management. And now we come to the issue I particularly wanted to focus on, which is relevant for those who have an interest in either competition economics or economy-wide productivity. The issue is the impact of passive investing on the concentration rate, i.e. the number of firms, or specifically the ownership of firms within each industry. Here, passive investing has an impact which isn't immediately apparent. That is, that passive investments bring a number of companies under common ownership, including where you may have a number of companies within the same industry. For example, when I listed some of the companies from the FTSE 100 earlier, I listed a number of companies that operate in the energy and oil industries and a number that operate in the banking sector. Let's have a look at a specific example. This is not taken directly from a passive fund, but it illustrates the wider issue of common ownership by investors. If you have an interest in investing, you may well be familiar with a company known as Berkshire Hathaway, led by one of the world's richest individuals, Warren Buffett. This company is a vast investment firm, and its strategy is typically to buy and hold companies. It will invest in companies for the long term. In 2016, Berkshire Hathaway made significant investments in 4 major U.S. airlines: American Airlines, Delta, Southwest Airlines, and United Airlines. And by December 2019, it owned substantial shares in all of them. In essence, this was it making a bet on the US airline industry as a whole. This was a bet the company was entitled to make, but from a competition economics perspective, it's problematic. A single investor with significant shares across all major companies in an industry materially reduces the incentives for competition. Consider competition between American Airlines and Delta. Normally, each airline would be vying to win passengers from the other. But with a high degree of common ownership, this effect is dampened. If passengers fly with American Airlines, the common owner benefits. If they switch to Delta, the common owner still benefits. This could therefore dampen, for example, price competition between the two airlines. Why would Delta reduce prices to win customers from American when the revenue is going to the same owner? The upshot of reduced competition stemming from market concentration can be higher prices, lower quality, or lower innovation. Accordingly, in future, there may be a role for regulatory bodies to monitor or address the risks associated with such high concentration. To start with, this may take the form of regulators being quite light touch, but providing guidance to passive funds about how they can construct their indices. In any case, passive investing is clearly here to stay. And in the meantime, for individual investors, it remains the cheapest option out there.